Welcome to Nasdaq Trade Talks. I'm Jill Malandrino, global markets reporter at Nasdaq. Joining me for this segment, we have Scott Nations, president of Nations Indexes. We're here to discuss if either a 25 or 50 basis point rate cut could be either bullish or bearish. Scott, it's great to see you as always. Welcome back to Trade Talks. And it seems as if it's like we're partying like it's 1999 and preparing for Y2K. Finally, some sort of rate cut that, for all intents and purposes, is going to happen this week.
Yes, the market is absolutely convinced it's going to get a rate cut. The size of that cut, whether it's 25 basis points or 50 basis points, the market has been all over the road the last 10 days. During that period, the market has been saying only a 15% chance of a 50 basis point rate cut at one point. And right now, the market is saying something very different. 61% market is saying are the odds of a 50 basis point rate cut, which is a little confusing because CPI and PPI data from last week was more or less in line. So it's tough to understand really what would drive that sort of a change in the market. But Jill, to your point, I think either of those could be bullish. Either of those could be bearish. It will depend very much on what Chairman Powell has to say afterwards, because let's face it, if he says, we did 50 basis points, we wanted to be aggressive, but we're going to take a couple of meetings off to gauge reaction, well, that would probably be bearish. On the other hand, if they do 25 basis points and say, hey, we're ready to cut, another 25 basis points at the next meeting and the meeting after that, and the meeting after that, if necessary, well, that could very well be bullish. So this is another one of those situations where the statement is really going to be the message that matters.
Right. And then, of course, the question is, has this already been priced in? And if you want to take the contra point of view of that, if they do the 50 basis points and say, we're going to take some time to see how well this is digested through the system, that could also be perceived as something bullish because they're not indicating that perhaps there is more stress in the economy than they would like to see. So it really is anyone's guess until he starts speaking and we start parsing apart how the Fed is interpreting, the labor market, how inflation is performing. Are we getting a soft landing? How the overall economy looks, what the trajectory is. It's been a really weird market. I know that that's not the most professional term to use, but it has been, to your point, past 10 days, just kind of bouncing back and forth, not really anything.
No, I think that's a perfect way to describe it. It's also somewhat of an ink blot. So whatever you see in this market right now is based on your way of thinking and regarding the market is. I also think it's easy for observers to look at the market and see, say, the S&P up 18% year to date, less than 1% from all-time highs, and say, why are we cutting rates at all right now? But I think the Fed has done something admirable and nearly impossible. It certainly looks like they've managed to engineer a soft landing. So congratulations, everyone. You've done what is nearly impossible. But that doesn't mean that investors should be complacent. We see that implied volatility across most of the measures is in about the 75th percentile, so it's reasonably high, which means people are not being complacent. That's a great thing. And that's important when we go into these sorts of things. One other issue, Jill, is, and you have to talk about this in the context of the looming election, I think the Fed is more interested in appearing to be nonpartisan than they might actually be interested in being nonpartisan. So I think that 25 basis points for that reason may be more likely than people are thinking.
Yeah. And Scott, that's a great point that you make in terms of how they have successfully engineered this. I know, there was such a fixation on Powell using the word transitory and perhaps, sticking with a more hawkish policy longer than perhaps was necessary. I don't necessarily think that's the case, but you have to remember too, there is no roadmap for coming out of a pandemic. We can recall lessons from the dot-com era. We can recall lessons from the financial crisis in 08, 09, but it's not as if there's some sort of way to benchmark this success or lessons that were learned in terms of the market and Fed policy for something that typically occurs every 100 years.
That's right. And Jill, you've been really nice to talk about my book on here. My book, History of the United States in 5 Crashes, where I talk about the 5 modern stock market crashes. And in that, I learned that the Federal Reserve isn't a vital player. And while the Fed can do some damage to the economy by keeping rates too high. The most egregious damage they've done to our stock market and economy was in the 1920s and then in the 2000s when they kept rates too low for too long. That is really when a bubble forms, when they do real damage, when excesses show up, when everybody gets levered. And so the Fed should be thinking about that. Yes, we can do some damage by keeping rates too high, but we really do damage by keeping them too low for too long.
Yeah, well, Scott, my next question could perhaps be if you do, an updated version on the book, the sixth error of this, right? It seems as if the market is so conditioned with everything that could potentially be a volatile event, and the news is happening so fast. We've seen every dip be bought. To your point, and you say this all the time on the show, that you're surprised at how fast vol is being sold. Maybe the way the market reacts to news is we're just conditioned the news cycle so fast. There's so much that's happening in the world. Maybe this is a new era of that.
Well, and I think traders have been conditioned. They've learned to sell volatility when it spikes and sell it very quickly, to rush in when most people would still be afraid to sell volatility. They rush in, they sell it pretty aggressively. They sell it back down it reverts to the mean because people are selling it very quickly. And I understand why traders are doing that. They're doing that because it has worked in the recent past, and we pay too much attention to what's worked in the recent past as opposed to what's worked over a longer time frame. And so I think what's going to happen is we're going to have some other event. Volatility is going to spike. A bunch of traders are going to come in and sell it back down. And we're going to find that decline in implied volatility is just a head fake and that it will make a new high. And I think that a lot of people are going to get carried out when that happens. You don't want to see that happen, right? But given the way that they're selling volatility, I think it's inevitable.
Yeah. I mean, Scott, you had said this the Monday after the August 5th vol pop that we saw. So this was August 12th when you were on, and you would make such a great point that the reversal of that move would take weeks or perhaps months, not just, an intraday session to, basically revert back to the mean, right? And when you think about it in that context, it really does define the era that we're in when it comes to selling vol, right?
Right. And I'm going to use a really geeky word here that we like to throw around the office. And it describes the way real volatility works. It's heteroscedastic, meaning that it's lumpy, or that realized volatility is low for a while, and then it's high for a while and stays high for a while, and then it's low again for a while and stays low for a while. So it doesn't bounce back and forth. It moves from one regime to another, to another, to another, and stays there in that regime for a while. And I think that we've forgotten that that's the way realized volatility works. We're looking at option prices, implied volatility. Everybody says, oh, these option prices are so high, I'm going to sell them. It's free money. And we know that occasionally it doesn't turn out that way.
Yeah, well, that trade works until it doesn't, right?
Exactly.
I appreciate the insight as always. Thanks for joining us on Trade Talks. I'm Jill Malandrino, Global Markets Reporter at Nasdaq.